Okay, good evening. Tonight is November 13th. So we just did quiz 4, and now I'm going to do chapter 22. It's probably with 17 the two easiest chapters of the course, so we should be done hopefully pretty early tonight. So announcements, nothing. The quiz will be returned next week, and if you're doing Go Help a Real Business, the timesheet's due by the last day of class, which is November 27th. So in leasing, I'm going to talk about the different types of leases. A little bit about accounting, but not too much. This is more of a finance course. Really, the two big, where the substances in this chapter is dot 4 and dot 5, which is really looking at the cash flows of leasing versus owning. And then the lease or buy decision you'll see is based on which of the cash flows is better. And then a little bit more knowledge after that. A little bit of vocabulary. So a lease is it's a legal contract, which somebody gets to use an asset without paying for it, but then they, in a sense, what they do is they rent the asset instead of owning the asset. Just use that, learn that terminology, lessor and lessee. So lessor is the party to the contract that actually owns the asset, but the lessee is the party to the contract that uses the asset and then pays lease payments to the lessor. That OREE ending is quite common in other settings. For example, you can have a franchisor and a franchisee. So a franchisor would be, say, the Tim Hortons Canada or Tim Hortons the whole thing, and then a franchisee would be one of the single locations. So that lessor lessee, it's got those similar kinds of ending. Direct lease. That's a form of seller financing. So if you're a company that makes stuff and you want to sell more stuff, what you do is, especially for the the marginal credit type of clients, what you do is you say, well, buy my thing, and then I will arrange the financing for you. So by far the biggest industry that does that is the car industry. But there's also, airplanes and networking equipment does it too. In fact, that's probably what got Nortel in trouble in the because they were to just crank out, their sales and their earnings continuously. What they would do is they would just give. Can't remember if it was more leasing contracts or financing contracts for companies that bought, but they were just selling their stuff or leasing it to companies that just went bust. They have, once you've sold your stuff to all the people that have decent credit, then you've gone through all the people that have medium credit. If you want to just keep selling your stuff, then you got to really go and sell your stuff to deadbeats. And what happens is you lose your shirt in those deals. So. Captive finance companies, subsidiaries that lease product for the manufacturer. The last 2 points are kind of related. So if you look at, like I said, car companies have their own leasing companies. So I think there's like Chrysler Financial, and then GE Capital is probably by far this is a billion, maybe even maybe not a trillion, but at least 10 or 20 or maybe 100 billion, in asset type of company. And what they do is, GE is a gigantic conglomerate, and what GE Capital does is they basically help. If you're one division is selling locomotives, the other one is selling MRI machines, and the other one is selling jet engines. Those aren't things that are very cheap. So. And those aren't things that are easy to walk into a regular bank and finance. So that's been one of the competitive advantages of GE over the years. It's the fact that they had this kind of in-house bank that they would then go and finance the products that they were selling through all their divisions. So this is, well, when we're going to talk about buying versus leasing. So when you buy, obviously, somebody makes something, and then a company buys it, and then uses that asset. What a lease does is it separates the ownership of the asset from the operating of the asset. This is more of an accounting term, but something to still today when I look at a lot of financial statements, if you're going to be a CA in your career, there's a lot of accountants that have this, even once they get their CA, they still don't understand the difference between those two. Or it's a financial lease, but they don't account for it properly on a balance sheet. So an operating lease is, oh, I think I have a next slide there. Yeah, an operating lease is a shorter term lease, whereas a financial lease is something where it's kind of a way of, you know, financing like you bought the asset, but it's more written as a leasing contract. The best example to give you to understand the difference between an operating lease and a financial lease, if you go to the airport and you rent a car for the week, a couple of days or a week or something like that, that would be an operating lease. If you go to a car dealership and you get a car lease where you're paying like $300-400 a month for 24 months, 36 months, that's an example of a financial lease. And there's different contexts where this applies, but in general, an operating lease is a shorter term. Sometimes sometimes you can cancel it. The concept of a financial lease, I think I have. This is the. I think the definition of CRA, but I don't keep up to date with those people. They tend to change rules quite a bit. But in general, a financial lease is where the lease term of the amount of time that you're leasing the asset is a good chunk or a majority of the life of the asset. So, for example, in the case of a car, yeah, you're leasing on it in 3 years. It's going to be called a financial lease, but it's because most of the present value of the car, even though the car is going to last maybe 10 or 15 years, most of the present value of the car is in the first couple years. So this is an example where it's not quite linear, but in general, the main thing that differentiates an operating lease from a financial lease is how long it is. So an operating lease is something that's pretty quick, whereas a financial lease is where you're leasing the asset for most of its life. Now, there's different definitions. CRA has one definition, CIC has a different definition, probably GAAP has another one, and IFRS maybe has another one. But in general, it's financial leases. You're leasing the asset for a big chunk of its life. Some specific examples of capital lease. Tax-oriented, sometimes, you'll see because of the tax shield of owning, but when you're leasing, you're not receiving that tax shield. It's better to have a lessor that pays higher taxes because you're getting the CCA claims, and then to have a lessee that doesn't pay. Or that pays a lower tax rate because then they wouldn't get as much of a shield from the tax shield of owning it. Leverage leases. This is used a lot, I would say, more in the startup or early phase type of companies where it might be if you look at the numbers, it might be more advantageous to own, but when you're starting a new company, you just don't have that much cash to, go out and buy assets. So sometimes the only thing that's possible is for you to lease because even though when you look at the cash flows and we do the financial analysis you're going to see in this chapter, even if even if one is better than the other, you just don't have the cash available to buy it. So leverage lease is just where you have a big part of the present value of the asset that's a part of the lease. A sale and lease back, that happens. I think an example of a deal like that happened not too long ago was the Scotiabank tower in downtown Toronto. Because Basel III is coming around pretty soon, and I think that building was worth a couple of $2 billion. In order to hit their Basel III capital requirement, what Scotia did is they sold their building to somebody else. I don't know, some kind of real estate investment fund, and then they just leased back the space. So they don't have to move. They just sell the ownership of the asset to somebody else, but then they just lease it and they continue to run it. They continue to use the asset as if they had before, but now they're not carrying the ownership of the asset on their balance sheet. In some cases, that's advantageous. In the case of Scotiabank, that's one specific example that I remember from current events. But I'm sure that if you go through business history, you'll see other ones. It's basically like the expression says, sale and lease back. So you sell something to somebody else, you own something that you're using, you sell it to somebody else, but then you rent it. And you end up, instead of owning it and using it, you end up leasing it and using it. There's different reasons why you would do something like that. Now, I'm not going to ask you in an exam, what section of the CICA guidelines, or I can't remember, it's called the book, the case book, or the something book. I can't remember what it actually. Obviously, don't worry about what number it's in, but there's a whole section of accounting regulations and guidelines on how you account for leases. Financial leases are treated basically like debt financing. One thing that people had done in the past with leases before proper accounting standards came in is that if you lease something, it wouldn't show up on a balance sheet, but you were in a legal contract to pay. Say you're leasing we'll use a hospital in the U.S. because obviously in Canada everything's government for hospitals. But think of a hospital in the U.S. where you have an MRI machine, and the leasing payments are maybe like $100,000 a year for 10 years. Well, you have to pay that. You're in a legal contract to pay that $100,000. But if you don't account for it properly, you look at the balance sheet, that liability doesn't show up on your balance sheet. So leases were a way of kind of pulling some shenanigans with the balance sheet by taking leasing obligations and putting them off balance sheet. The idea of the financial lease and how it's accounted for is you report the ownership of the asset as a fixed asset, but then what you do is in the liabilities you just report what your remaining lease payments are. So that's how financial leases are accounted for, should be properly accounted for on a balance sheet. And you'd be surprised how many people that have CA at the end of their names still don't understand that. So I've already talked a little bit about the difference between a capital lease. Capital lease, financial lease means the same thing. A big one is the lease transfers the ownership by the end of the lease terms. So something like a rent-to-own type of arrangement. Or it can, well, really the first two yellow points there are kind of the same. The second one is where what I was saying, really the third and the fourth are really kind of related, in that the main criteria for deciding whether something is an operating lease or a financial lease is what percentage of the life of the asset is that lease for. So if you have a piece of equipment that's expected to last, say, for 10 years, and you have a lease for an 8-year term, that's obviously a financial lease. So looking at how different ownership arrangements, so you have the case 1 is where you just own something. Case 2 is where it's an operating lease. And case 3 is where you have a capital lease. But I'm not really going to ask you much about, accounting. I'm just going over quickly. Really, the real meat of this chapter is when we get into the cash flows and the lease versus buy decision and break-even lease payment. But before I get into this, I need to explain this concept. Well, really, remember that one of the main differences between 2505 and 2504 is in 2504 we a lot of times just ignore the existence of taxes to make things simple to understand and kind of introduce basic concepts. In 2505, any financial analysis that we do for any of the different chapters that we have, you always look at what are the tax effects on the cash flow when you do your analysis. In the case of leases, well, the first one, that has to do with a lot of small businesses. What they do is I've seen this lots of times looking at financial statements of small businesses where on the expenses of the company, there's a lease for the owner, there's a lease for a car for his wife, there's a lease for the kids and so on. That's it's a way that business owners have used to flow, because normally what you would take a salary or have dividends from a company and then have personal expenses. If you lease cars through the company but then you use them for personal reason, that's one way to kind of get around the tax regulations. It doesn't. The points are not in there, but there's. I was looking. The main point to understand about taxes with leasing is that when you own something, you have CCA on it. So you have a CCA deduction. So you get a CCA tax shield from owning something. When you lease something, you don't own that asset. You get to, obviously, your leasing payments are operating expenses. So in after-tax terms, the actual amount that something costs you, the after-tax lease payment is whatever the lease payment is times 1 minus t. Remember that anytime you see something multiplied by 1 minus t, it's converting an amount from pre-tax to after-tax. If you own something, then you get that CCA deduction. If you lease something, you don't get that CCA deduction. So when we're doing the incremental cash flow analysis between owning something and leasing something, the different incremental cash flows are, if you lease, then you have the leasing payments. If you own, you don't have those leasing payments. So that's an incremental outflow from leasing something. If you lease, you don't receive the CCA tax shield. So that's another incremental outflow. Now, the third point is pretty important. If you lease, then you don't have to pay a big chunk of money at the start in order to start using the asset. So once I think it's the next slide. Oh, show you a second. See, if you look at the incremental cash flows here of leasing versus buying, when you lease, this is something that, a piece of equipment that costs $10,000. So when you lease something, you get to use something that's worth $10,000 without having to fork off that $10,000. So that's an incremental inflow of leasing versus buying. You don't have to to have an outflow of $10,000 in order to have the asset and start using it. But you do have to pay the leasing payments, and then you get, obviously this is after tax, and at the same time you lose, once you lease, you lose having the CCA deduction each year. So the initial amount that you would have spent on the asset, that's an incremental inflow from leasing. Right now what we're looking at is what is the difference between leasing and buying, and so we're looking at those incremental cash flows. So that was the third point. And then if you lease or if you own or lease, sometimes you'll have different things like maybe if you lease, the insurance is included or something like that. You just have to read the question and figure out what the proper incremental cash flows are. But remember, they're not. When we're doing, this is going back to very basics of this course, chapter 10 and 11. When you're doing a cash flow analysis, you're always looking at incremental cash flows, not cash flows in absolute. So you look at a cash flow that would happen or not happen based on what the situation is. So right now we're looking at the buying versus the leasing. After-tax lease payment, that's a pretty simple one. The idea being that in this case you're leasing the equipment for $14,500 a year, but because leasing payments are part of your operating expenses, when you look at it from the point of view of an after-tax cash flow, it's not actually costing you $14,500. It's costing you So if your lease payment is $14,500 and the tax rate is 34%, then in after-tax cash flow, it's really only costing you $9,500. This is similar to, say, going back to chapter 14, if you're paying, because interest payments are deductible, if you have debt that's at 10%, in after-tax terms, and say the tax rate is 50%, you're not really paying 10% on that debt when you look at from the point of view of what is your after-tax cash flow. You're only really paying 5%. This is a similar concept here, but where we're talking about the lease payment instead of what the interest payment is. Here's an example of the depreciation tax shield. Now you've seen this before. This is just a little bit of review. So So you buy something for $38,000. Now the CCA rate on that asset class is 30%, but because you have the half-year rule in the first year, you only get to deduct 15% of it in the first year. So your CCA deduction for year one is going to be $5,700. So the undepreciated capital cost, which is, remember, is CRA's way of saying your net book value, is $32,000. 300. So if you then your CCA deduction is 9690, then the CCA tax shield in year 2 is going to be the CCA in year 2 times the tax rate. And a lot of students confuse, I'm sorry if I'm repeating myself, but I just want to make sure that you get it. A lot of students confuse the CCA from the CCA tax shields. Those are two different things. Well, obviously they're related, but the CCA is the amount that you deduct from your income, from your taxable income. The CCA tax shield is how much cash money you're saving on your income tax from having that deduction. So in this case, the CCA deduction in year 2 is 9690, and the tax rate is 34%. So you save $3,295. So if you have an asset that goes from $32,300 and you get a deduction of $9,600 in year 2, then that means you get to pay $3,200 less in taxes. And here's the key point here. If you lease something, you don't end up having that advantage. If you own something, you have the advantage of receiving that CCA deduction. If you lease something, you don't get that CCA deduction. So when you look at the incremental cash flow analysis of buying versus leasing, the CCA tax shield is lost when you lease. So that's going to be an incremental outflow when we look at our lease versus buy decision. So here's a little story here. TransCanada needs new cars. The cars are going to cut. By the way, I think this is the example that's actually in the textbook. That's where the slides came from. So the cars would cost $10,000 each, and would be depreciated at a CCA rate of 40%. They would help the sales force generate $6,000 in additional sales per year for 5 years. Now, that $6,000 is going to happen whether you buy those cars or whether you lease those cars, right? Because you're going to have cars to give. They go to sales force, yeah. So you're going to have these cars to your salespeople. They're going to go out there and generate $6,000 in additional sales. But whether you buy the cars or whether you lease the cars, that $6,000 is still going to come in. So when you look at incremental cash flow or lease versus buy, that is not an incremental cash flow because it happens whether or not you buy or lease. No salvage is expected after the 5 years. You'll see an example a little bit later. If that's another difference between buying and leasing. If I buy a car, then once I get rid of the car, I get to sell it used to somebody else. If I lease it from the dealership, after my 24 months or 36 months is done, I just give it back to the dealership and I don't get to sell it to anybody. So when you own something, you get to salvage it at the end of your use of it. When you lease something, you don't. So that's going to be an incremental cash outflow from the point of view of leasing. Just in this case, it says there's no salvage. You'll see an example later where there is a salvage. Alternatively, the company can lease the cars for $2,500 per year, and payments are due at the beginning of the year. That's another twist about leasing. Think of how you pay. The lease that most of you are familiar with is the rent. Right? You pay your rent on the first of the month. You don't get to live somewhere, and then at the end of the month, you go and you pay the landlord, because a lot of people will just, leave on the 29th or 30th, and the landlords would always get screwed for their money every time somebody would leave for the last month. Anytime, now this, never say never, but I would say most leasing contracts, you pay at the beginning of the period. So for example, if you go and you lease a car from a dealership, it's not, you get to use the car for the whole month and then you have a leasing payment on the 30th or 31st of the month. It's, you pay the leasing payment on the 1st of the month and then you get to use the car for that amount. And then you pay for the 1st of the month and then, I saw a really interesting company once where they were doing this kind of leasing cars. They had those anti-theft device in the cars. And then if you didn't pay, they had it set up with the credit card system. And if your payment didn't get through, your car wouldn't start. And so I thought that was a pretty cool little business model. Because you made sure that people would pay their car payments, otherwise they couldn't start the car. So with all the story, what are the incremental cash flows? Well, if you lease something, you're going to have, remember, we always look at cash flows from the point of view of after tax. So they're going to cost you $1,500, does it say a year or a month? Per year. If you buy the car, you will have to pay $10,000 at the beginning. If you lease the car, you don't. So from the point of view of leasing, that's an incremental inflow. You get to use something that's worth $10,000 without having to spend the $10,000. So that's the main advantage of leasing. You don't have that huge cash outflow in the beginning. And then at the same time, if you lease the car instead of owning the car, then you don't get to deduct, you don't get the CCA deduction every year, so you don't get the tax shield savings. So if you put that together, you see that this is very similar to cash flow analysis that you've seen before. So you have, well, now you have a cash inflow in year 0, which is what happens today, and then each year, obviously, because the further you go into, it does say somewhere before in the question. It doesn't say the discount rate that they were using for that question. That's why they're actually, no, when you look at that, they're not discounting those. It's just because when you look at something that's declining balance, you will get to deduct less and less over time. Sorry, I was looking, anytime I see something that looks smaller and smaller, I think of discounted cash flow. So when you want to know lease or buy, what you do is you compute. So going back to our car example, if I lease instead of own, then today I have a net advantage of $7,700. But then for year 1, it's going to cost me $2,700 more to to lease, $2,200 more in year 2 to lease, and so on. So what you want to know is, what is the net present value of that series of incremental cash flows? So you look at the incremental cash flows like I've talked to you about. So the initial inflow that you don't have to spend the money. I'm talking from the point of view of the lease. The initial inflow from not having to spend the money on the asset, and then the outflow of having the leasing payments over the life of the lease, and then the outflow of not receiving the CCA deduction each year. So you take the net present value of all of that, and the discount rate that you use is the cost of debt, not the average cost of capital. Because you look from the point of view of, if you were financing, if you were owning something and financing it, you'd be able to get debt financing, because typically, stuff like car payment, any kind of asset, you can usually do a secured loan, so you're able to finance it at the debt rate instead of your average cost of capital. So that net present value of the incremental cash flows of leasing versus buying is called the net advantage to leasing. If the net advantage to leasing is positive, then you're better to lease. If the net advantage to leasing is negative, then you're better to buy. In other words, when the net advantage to leasing is bigger than zero, then the incremental cash, the cash flows of leasing are smaller than the cash flows of buying, and vice versa. So in the previous example, the cost of debt was 11%, so you need to convert it to an after-tax, so you multiply by 1 minus t. So if your pre-tax cost of debt is 11, then your after-tax cost of debt is 6.6. So that series of cash flows here, you know, plus 7,700, minus 27, minus 22, and so on, when discounted at 6.6, gives you a net advantage to leasing of minus 199. So what that means is, from a cash flow perspective, it's more advantageous to own instead of buy. So let me do an example here of how you calculate this net advantage to leasing. So the after-tax lease payment is going to be the lease payment converted to after-tax. So that's, the lease payment is $25,000. The tax rate is 30%. So the lease payment is $17,500. We're going to need in a bit what the discount rate is, so we also need to convert to after-tax what our cost of debt is. So if we're paying 10.5% on our debt pre-tax, then we're really paying $735 after-tax. Now, there's two ways to, when it comes to looking at the difference in tax shield, there's two ways to do it. Either you take, you calculate your full depreciation tax shield, for each year, and then you take the present value of it, or you just use the present value of the CCA tax shield formula and get it done in one shot. Salvage. Yeah, it's worthless at that time. So remember, there's another part, salvage times whatever. Since there's no salvage, well, in the present value of the CCA tax shield, that's not going to show up this time. It's going to be a little bit small here. You can just go on YouTube later and zoom it up. So in this example, if you buy the we're buying the distillation unit, then you get, in present value terms, you get savings of $21,000 in income tax. If you lease instead of buy, you don't get to save that amount. So that's going to be an incremental cash outflow from the point of view of leasing. And the next one is, what is the net advantage to leasing? Well, that's going to be the present value of the after-tax lease payment. Well, I'm actually going to do this one first as a separate thing. Now, remember that the lease payments are an annuity, and because in leasing, the cash flow, you're making your lease payment at the beginning of a period, what you have is an annuity due instead of a regular annuity. So the formula would be and this is the difference. If you just have that, that's a regular annuity. If you have that extra 1 plus R at the end, that's the formula for an annuity due. So an annuity where the payment occurs at the beginning of the period instead. So over the life of that lease, the present value of all those lease payments is $76,000. So when you look at what is the net advantage to leasing, well, remember that from the point of view of leasing, the fact that you don't need to spend the cash up front, that's an inflow. Then you do have to pay the after-tax lease payment. So that's I is an incremental inflow. The present value of the after-tax lease payment, that's an incremental outflow. And you also lose the present value of the CCA tax shield, because remember that when you lease, you don't get the CCA deduction. So that's another negative incremental, not negative outflow, an incremental outflow. So I is 100,000. Present value of the after-tax lease payment is 76,311, and present value of the CCA tax shield is 21,187. So final answer is . So in this case, because the net advantage to leasing is positive, it's better to to lease the distillation unit than it is to buy them. So let's look at an example with what happens when you have salvage. It gets a little bit more complicated. So first, you always have to know, well, that's going to be the same. You need to know what is going to be the discount rate that I'm going to use for that problem. So it's the after-tax cost of debt. So the present value of the CCA tax shield using N. Yeah. It's not going to fit in single line there. Obviously, I'm going to give that formula to you in a final exam. I don't have to say quiz or midterm anymore, so you only have the final exam left. So the initial purchase here is 15,900, and it's just a matter of plugging in a bunch of numbers. That's one fraction, a minus, and then the other fraction. Confuse those two. So that big ugly mess is equal to 4273. So if you lease instead of buy, then you, in present terms, you won't get to save that 4,200 in taxes. The present value of the after-tax lease payment oh, and the notes the after-tax lease payment's missing. I'm missing the number here. There's a mistake in the. Can somebody calculate for me what 15,900 times 0.65 is? I'm missing another point. 1.04875. So that's equal to so here's the key point here to understand when you have a net present, a net advantage to leasing question where there's salvage versus not salvage, the salvage shows up in two different places. It shows up in the fact that when you calculate your present value of the CCA tax shield, you will have that second term where you don't get the, it shows up there, but at the same time, you have the loss of salvage. That's an actual cash flow, not a saving in tax. So we're just, leasing some equipment. It doesn't tell us what it is. If you own this equipment, at the end, when you're done with it, you get to resell it for $400. If you lease that equipment, when you're done with it, it's the owner of that asset that gets the $400. So from the point of view of leasing, the salvage shows up in two places. It shows up in the second term of the CCA tax shield, but it also shows up in the fact that you don't receive that actual salvage cash flow at the end. So make sure you know it's not just when you have a salvage question, a net advantage to leasing with salvage versus not salvage. Salvage actually shows up in two places in the question. So now you just put all of this together. So the net advantage to leasing is you receive the use of the asset without having to pay for it. So that's an inflow. You don't get to deduct the CCA over its life. You do have to pay the lease payment, but from the point of view of cash flow, this is an after tax. And then here's the other one. When you lease something, you don't get to sell it used when you're done with it. So when you look at leasing versus buying, that's an outflow. So the salvage shows up in two terms here. It shows up in that one and shows up in that one. So just putting all the numbers together that we had so far. So if you, yep.
For PV of ATLP, we took 10,345, but we should have taken let's go ATLP. We took 15,900.
Yeah.
But 15,900 is the purchase price, not the lease payment. Should have taken the lease payment, right?
Wait a second. What did I use here? Yeah, good point. Yeah, the lease payment at, alright, so yeah, I need to fix that. So what's 5,600 times 0.65?
3640.
364. Right, so that's the after-tax lease payment shows up when you figure out the present value of that series of cash flow. It's probably still 10,420. If you can test that, you just here's the trick. When you're doing this question, you can write it out this way, but this is really just an annuity. So you put your calculator into annuity do mode by pressing second begin, and then you see BGN at the top of the screen. So then the payment is 3640. The rate is 4.875. N is 3, and that's it. Then you compute the present value, and you should get 10,420. Thank you. All right, so here's a good spot to take a break. Okay, so it's 8 o'clock. Let's continue. So far I've shown you net advantage to leasing without salvage and with salvage. So now what I'm going to introduce is the concept of the break-even lease payment. So if you look at when our lease payment was $2,500, the net advantage to leasing was minus $199. Right, that's that original example that we did. Now, if the lease payment instead was $2,000, and you redid that net advantage to leasing analysis, now you get a net advantage to leasing of 1,1126. So when the lease payment is $2,000, it's better to lease, and when the lease payment is $2,500, it's better to own. So basically it looks like this. So somewhere around here is what we call the break-even lease payment. So I just showed you the picture there. So in that textbook example, it was Trans-Canada and the cars. When the lease payment was $2,500, it was minus $199. But the net advantage to leasing is positive when the lease payment is $2,000. So that means that somewhere between $2,000 and $2,500, there is a lease payment that makes the net advantage to leasing equal to 0. That is called the break-even lease payment. It's the lease payment where net advantage leasing equals 0. At the break-even lease payment, it doesn't matter whether you buy or lease, because from the point of view of after-tax cash flow, the cost is identical to both options. That's why it's called the break-even, or you can say you're indifferent. You do one or the other. Makes no difference because it's costing you the exact same whether you buy or lease. So how do you find what that break-even lease payment is? the net advantage to leasing is the investment minus the present value of the after-tax lease payment minus the present value of the CCA tax shield. Just for simplicity right now, I'm just going to assume that we don't have salvage. It's just a minor complication if you do. So you want to know when that is equal to 0, what is the after-tax lease payment? What is the lease payment? So first, you just rewrite that equation. So you know that I minus PV AT minus PV CCA tax shield is equal to 0. So I just take that on the other side, and I'm left with present value of the after-tax lease payment is I minus PV CCA tax shield. Then, sorry? No, because all you did is you took this and you put it on that side. So you're left with I minus PVA CCA tax shield stays here, and then this is plus PVA, right? It's just because I ended up, flipping it, but anyway. So then, to find what the break-even lease payment is, you basically run the net advantage leasing problem backwards. You start with, this is the net advantage to leasing that I want, which is 0. And then I find what is the present value of all my after-tax lease payment. And then I pull out the payment from the annuity formula, so then I know what is my after-tax lease payment, and then I convert it to pre-tax. So let me show you an example. Oh, I missed one little thing. So the cost of debt is 8.5, and the tax rate's 34%. So the after-tax cost of debt is 5.61%. Because I'm going to need that K right here. So my what's the investment? It's 195. So I know that present value of all my after-tax lease payment has to be equal to 140. So I take the annuity due formula. So now I know the present value, I know the rate, I know the time, but I want to figure out what is the individual payment. So I rewrite that formula as now what I have is what is my after-tax break-even payment. What I want to know is what is my pre-tax break-even payment. So I take that 38. Remember that when you take a number and you multiply it by 1 minus t, you convert it from pre-tax to after-tax. If you take a number and you divide it by 1 minus t, you convert it from after-tax to pre-tax. So this is the after-tax lease payment. So to get the lease payment, getting a little bit tight on space here. So that's how you end up at 57,705. For a second for the video. Alright, don't quit. See it. Okay, so the leasing paradox is, if you look at a lessor and a lessee, which have the same tax rate, then leasing is a zero-sum game. There's, from the point of view of finance, from the point of view of cash flow, this is almost a contract that shouldn't exist. Because it's basically, I'm going to give you a $20 bill and you're going to give me a $20 bill back. What's the point of doing it? Because in present value terms, if you have the lessor and the lessee with the exact same tax rate, then it makes no difference. Whatever the cash flows of one should be the cash flows of the other. Here's the key point. That's not true when the lessor and the lessee have different tax rates. So when you have, this is a little bit of international finance, but when you have, say, two companies that are under the same parent, but they're in different tax jurisdiction, where one tax jurisdiction is much higher, the tax rate, than another one, then what you do is you have the assets owned by the subsidiary that's in the jurisdiction where the tax rate is higher, and then you have that subsidiary lease the assets to the other related company that's in a different tax jurisdiction where the tax rate is lower. Because remember, you want to own assets where the tax rate is the highest, because that's where you get the biggest tax shield. You want to lease assets where the tax rate is lower, because you don't get as much of that tax advantage from owning the asset. On a related point, if you're running a nonprofit, it's almost always, I never say always for anything, but in general, for a nonprofit, it's always better to lease, because you don't have that tax advantage of owning. So if that's why, as a nonprofit, you should pretty much lease everything that you can. And I actually do that little trick even for myself. I own a business in Quebec and a business in Canada. In Canada, there are two countries to be. So I got one in Quebec, which is the tax rate is 19%. And I got another corporation in Ontario where the tax rate is 15%. So what I do is my Quebec corporation owns everything, but then leases the stuff that's in my basement. It's actually owned by the Quebec corporation, but it leases it back to my Ontario corporation that's in my basement. There's a little bit of, I just saved 5%, but if I don't have to give 5% to a government, I'm happy with it. So, but bigger companies do that all the time, and it's not just with owning and leasing. There's things where the jurisdiction where you have a higher tax rate will be financed more with debt, because it will have the interest tax shield, and then you'll have either the parent or a related subsidiary loaning money across borders, and that's a way to shift your tax burden from jurisdiction to jurisdiction through leasing contracts of assets or through debt between related corporation within a big global setup. Good reasons for leasing: taxes may be reduced. That's not quite true. It's more the other way around. May reduce some uncertainty. That's I would say, obviously I'm not a psychologist, but I would say that's one of the reasons why people prefer to lease a car instead of buy a car. Because when you buy a car, there's quite a bit of uncertainty about what you're going to be able to, you buy a car for $30,000. You want to use it, say, for 5 years. You have no idea what you're going to be able to, well, you might have, but there's quite a bit of uncertainty about, am I going to be able to get $5,000 in 5 years for it? Am I going to be able to get $10,000? Am I going to be able to get $20,000? When you lease, you know what your payments are for the life of the term, and then that's it. Boom, you're done. So, but with ownership, you have that uncertainty at the tail end of what the salvage value is going to be. So that's a non-tax advantage of leasing, in that you reduce the uncertainty of what your cash flows are going to be over the life of the asset by not having that uncertainty of what you're going to be able to get at the end of the term. May have lower transaction costs. That's true certainly true in real estate. When you buy real estate, you have to pay these land transfer taxes, and when you sell real estate, there's a pretty big commission that goes to the real estate agent. But if you rent a house, then you don't have that big bill at the front end to the government and that big bill at the back end to the real estate agent. May require fewer restrictive covenants. That's kind of related to the story I was telling you about Scotiabank and their office building in downtown Toronto. By taking what was a big thing on their balance sheet and converting it into, receiving the cash from selling it to somebody else, and then having the leasing payments instead, they were able to better meet the Basel III covenants, or ratios, whatever you want to call them. And well, the last point is not quite true because whether you own or lease, if you stop making your payments, somebody's going to take that asset from you. So it really makes no difference whether you buy or lease. Encumber fewer assets than secured borrowing. Either way, if you buy something, you buy a car, and then you have a car loan, that loan is secure against that car. So if you stop making your car payments, the bank takes back the car. If you lease the car and you stop making your lease payment, the lessor takes back the car. So that last point's not quite right. Some not so good reasons for going to leasing. It's a way of having fairly extreme leverage. It's always a good idea to just in general, to own a little bit of something, like to have at least 10-20% equity in something you own. So when you do a leasing where you have no down payment to the lease, then you end up with what essentially is an all debt purchase. So from the point of view of leverage, that's a highly leveraged acquisition. Now, other reasons for leasing, that's more in giant companies where they'll have, the bigger the companies get, the stupider the rules get sometimes, where like subsidiaries are able to kind of pull shenanigans where if they lease something, it doesn't count towards a certain, they might have a capital investment maximum that they can spend on buying stuff, but if they lease it doesn't count towards, so they'll lease instead of buy. But if you have a company that has this kind of issue, then you really have much bigger issues in terms of the bureaucracy and how your controls are set up in the company, that the subsidiaries are pulling or making financial decisions not based on the pure financial reasons, but just to get around the stupid rules that you created at the parent company. It's better to just go and clean up your management there. So I just have we'll take a very quick 5-minute break if you want to leave. I have just one more example for tonight, which was the break-even lease payment with salvage in it. But that's really no new material. That's the only thing different about that example is that example I just did, but with salvage instead of no salvage. So it's 8:21. We'll start again at 8:25. So you have a company that needs to buy a computer-operated turret lathe. I don't know what that is, but some kind of machinery, some kind of machining equipment. That piece of equipment costs $440,000. You can borrow at 9.5%, and after 5 years, you will be able to sell it used for $50,000. So if you lease, you don't get to sell the equipment at the end of its life for $50,000. If you buy, you do get that $50,000. So remember, that $50,000 is going to show up in two places: the lost salvage cash flow, but also when you calculate the present value of the CCA tax shield, it shows up as the second term there too. So enterprise leasing will lease the equipment at $100,000 per year. So that's the pre-tax lease payment. Tax rate is 34%, and the CCA declining balance is 30%. So first thing we want to know is what is the after-tax cost of debt. Then we need to calculate the present value of the CCA tax shield. Now remember, the debt doesn't change based on what the lease payment is. No matter what the lease payment is, the present value of the CCA tax shield is always going to be the same. It's kind of boring for now. It's just plugging in the numbers. So we know that the investment minus the present value of the after-tax lease payment minus the present value of the CCA tax shield minus the present value of the lost salvage, that's equal to 0. So we want to know what is the present value of the after-tax lease payment. I didn't calculate the present value of the lost salvage separately because it's such a small formula. It's just 50,000 discounted back 5 years. So we'll type 293,396. So now we know what is the present value of the after-tax lease payment. So we turn the annuity formula backwards to get what the after-tax lease payment is going to be. So remember that that is the after-tax lease payment. So a lot of students stop there. Now what you have is the after-tax lease payment. What you want to know is what is the pre-tax lease payment. So that's it. So I will see you next Tuesday for mergers and acquisitions.